a loan agreement is a formal contract between lender and borrower, right? It also spells out the details of the transaction. It not only provides, how much money is being borrowed. It also specifies for how long that loan will be in effect, what is the rate of interest, if there is any collateral that is given for that particular loan. Most importantly, what is the objective of the loan? If you will see in loan agreements, it is always specified, the first clause in a loan agreement after you have your boilerplate, where you have your details, recitals, then your definitions, etc. After that, the first clause that comes into being is the purpose of the loan clause, which is a very important clause, wherein the objective for which the borrower has asked for the loan is mentioned. And if you will see in all these loan agreements, it is clearly written that the objective of or the purpose of the loan cannot be deviated to, right? It essentially means that once whatever objective for that loan is provided in the binding agreement, that is the objective for which the money has to be borrowed and used for. The borrower cannot use the funds for any other objective other than the one which is mentioned in the agreement, right? So that is there. Then we have the loan term, we have the rate of interest, we have any events of default mentioned, then what is going to happen, what are the consequences if any event of default has happened, a material breach undertaken by the borrower, right? Another thing that would be our conditions precedent and subsequent. These are things that we will be talking about in depth, right? Protects both the borrower and the lender. Absolutely, it provides mechanisms for which, in case we have laws, especially US has laws, wherein they discourage lenders from charging exorbitant amount of interests, right? These are called usurious interest, USURIOUS. Usurious interests are basically exorbitant amount of interest that are unlawful, okay? And if any lender charges that to a borrower in the States, they will have to be liable for 3 times of that amount, right? All of that is given in the legislation. Now, this particular penalty that I'm talking about is specific to Texas, right? Similarly, in other states' financial codes also, you'll find, language for what happens if exorbitant rates of interest are charged on the borrower, right? So now that we've understood what a loan agreement is, let us go on to the next slide. Kinds of loans, the different kinds of real estate loans that are prevalent in the USA market, okay? First one being acquisition loans. As the name suggests, if I have borrowed loan from a bank in order to acquire a real estate property or a real estate project, a ready-made, a manufactured or a under construction real estate project, then that money would be termed, or that loan would be termed as an acquisition loan, because I am borrowing that loan to acquire real estate, right? Similarly, construction and development loans, as the name itself says, it is when a borrower, for example, I borrow money from a bank or a third-party financier in order to construct and develop a real estate project, right? So, can you guys give me an example of a builder, or say a real estate builder group in India, which is very, very famous? They have undertaken a lot of these real estate, housing, correct? DLF, Prestige, Piramal is one of them, MR, right? Okay, so absolutely. So these are all builders, right? These are real estate builders who actually undertake or acquire these huge amounts of loans over a very, vast period of time, mostly 5 to 10 years, right? They acquire these loans in order to basically construct and develop housing projects, right? In which it will always be a proper apartment type structure or a condominium type structure where there are buildings and every floor has 3 to 4 apartments, right? That is the structure that these builders mostly follow, right? Because the amount of loan that has been incurred is so huge. In order to make money off of that and also repay the lender, they have to sell individual flats, right? So which is why these huge complexes, these huge real estate real estate projects are undertaken by these builders under the construction and development loan. I'm glad that all of you know so many builder groups, right? Which is excellent. Guys, am I not audible? Savita says that she cannot hear me. Am I audible? Yeah? Okay. Savita, I request you to kindly reconnect. It could be just a network issue. Okay, then we talk about bridge loans. Now, do not get confused by the name thinking that this could just be a loan to construct a bridge. It is absolutely not. Okay, a bridge loan is just the opposite of a permanent loan. It is a temporary loan that is given to a borrower right before a permanent financing is to take place. Let me give you an example. Okay, say for example, you have taken a loan from a bank, okay, and that loan is to be disbursed not on the day that the loan application was approved, but say 6 months down the line. Okay, so if the loan is to be disbursed to you after 6 months and you need funds right now, you need funds for the 6 months up until the loan is going to come to you. What are you going to do till then? Right? For that 6 month period, you will take a temporary loan, which is called a bridge loan. Okay. Can I repeat acquisition? 1 second. Before a public issue proceeds, a bridge loan can be availed. Could you please explain that a little more on the chat, Lakshmana? Yes. So guys, for all of you asking what are acquisition loans, Lipi has answered. Okay. It is basically to acquire a real estate property, right? Bridging finance. Yes. Bridge loan is basically temporary loans that are given before the permanent loan is to be dispersed to the borrower, or if any existing obligation requires a very requires instant loan that the borrower may not be able to avail. For let me give you another example. Say you want to buy a new house. Say you already have a house, right? You want to buy another house. What is your plan? Your plan is that you will be selling your existing house, and with that money you will be buying the new house. Now say for example, your existing house is not yet sold, okay, or you have a buyer lined up and the sale is to be effected in the coming week. Within that week, you also need to finalize and pay a down payment for your new house, right? But you clearly do not have the funds, because only when you can sell your existing house can you get the funds and you can finally buy the new house, right? So before the bank can give you the permanent home loan for your new house, a certain amount of loan is still required by you to pay the down payment, right, to make the down payment. Now that short-term financing is called as a bridge loan. It is essentially, think of it like a bridge. It helps you move from point A to B without you having to travel all the way around, right? So it essentially, bridge loan is trying to gap that time period when you are in need of loan but cannot get it because of the time period that it may be disbursed on later, and you require instant funds right now, right? So you go for a short term or temporary financing. Okay. Can it be repaid from the main loan? It will be considered as a separate loan. Now see, understand the nuances of this. If the financier is the same, right? If you are availing the bridge loan from the same bank that is giving you the permanent loan, you may choose to pay back the bridge loan together with the permanent loan, right? You can obviously talk with your bank and you can get that fixed. If the financier for your bridge loan is a different entity than that for your permanent loan, obviously that will be treated as two separate loans and have to be paid in two separate ways, right? So two separate loan agreements will be entered for the same. Okay, it only depends on who your financier is. If your financier is the same person, yes, it can be clubbed. If your financier are different, then it cannot be clubbed and it has to be paid as separate loans. Okay, does this answer all of those who are asking? Before IPO funds utilization, banks will provide bridge loans. Exactly, because they need funds at that instant, and funds will not be made available up until a certain point of time in the future. So they need something to bide by them, right? Would the interest for bridge loan be higher or lower than the long-term loans? I think it depends from institution to institution, but whatever is the loan amount, the interest rate does not change, right? So if you have been, say, if you want to borrow 100 rupees as your bridge loan and 10,000 as your permanent loan, if the rate of interest, in the markets is say 5%, that will be charged on both of them, okay, regardless of the amount of loan that has been dispersed. Okay, so I think I've answered your question also, Aviral, how it is to be repaid. If it is to the same financier, it can be repaid in the same way as the permanent loan is to be done. And if they are different, then they have to be repaid accordingly as per what is negotiated between the borrower and the lender. The rate of interest may be more than the permanent. Absolutely, it could be, because it is a short-term loan, right? So they would want, the banks or the lenders would want to make money off of that as much as they can, right? So the rate of interest could also be higher. So the bridge is provided only after approval of permanent loan? No, not necessary at all. Is it like a mobilization advance given to get the project started and later deducted from the final payout? Yes, it absolutely could be. In this example that you are saying, Bharat, this could be where, one financier is involved, right? In that case, absolutely. Can I get more examples of bridge loans? Okay, let me give you another example of what a bridge loan could be, right? So say, for example, you as a developer, you have borrowed some loan in order to start a real estate project. Okay, now before the bank can disperse the loan, say the date for the dispersal is after 2 months. Okay, right now on this day you still need funds to, say, buy the raw materials, hire your independent builders, contractors, consultants, etc. You still have to get started on your real estate work, right? You cannot wait up until 2 months for the bank to finally give you that money and you can finally start on your work, right? So for the 2 periods, for the 2 months, right, for the next 2 months that you require the loan, but the loan will not be disbursed until after the end of 2 months, you can borrow another sum of money from the same bank, which could be called as a bridge loan, right? Now, if it is from the same financier, you can club the bridge loan and the permanent loan together, pay it off as a single loan. If you have borrowed that bridge loan from a separate financier, that will be dealt separately. A separate loan agreement with separate terms will be dealt with. Okay, does this answer your questions, guys? Is bridge loan clear to everybody? Great. And next one being permanent loan, we just talked about, right? Also, guys, a bridge loan, the most common time period for a bridge loan is anywhere between a few weeks to a few months, right? It is always a temporary loan for a very short period of time. Permanent loans, just the opposite of that. Okay, any amount of money that is taken over a longer period of time, the due date and the term for that loan is a longer period of time and is required, for your major real estate projects would be permanent loan. The only, I would say, difference or the characteristics of bridge and permanent loans are the time period. Bridge loans are for a short period of time. Permanent loans are for a longer period of time. Okay. Mezzanine loans, on the other hand, I have talked about this concept in my other classes. Previous USD students can tell me what mezzanine loan or mezzanine means. Can you guys tell me on the chat? Yes, we have covered this concept number of times. Mezzanine, guys. No, no. Equity based loans. Yes, Krati, thank you so much. That is the right answer. Mezzanine is a hybrid form of debt that has both equity and debt features. It basically simply means that your lender is giving you a sum of money as a loan today, with the option that, say, after 2 years, he has the option to convert that debt into equity in your company, right? So for these kind of loans, the rate of interest is always higher.